Hello and welcome to this week's Flash. My name's Shek. It's Sunday the 19th of October. Now today I've got a lovely low-vol industrial short view, Cintas. But I need to frame it within this wonderful two-tier market that we're all trading at the moment. Clearly there's only one game in town still. We can't have too many data centers, too much compute. We love all these circular deals and obligations with enormous numbers. Retail's buying the dip, weapons-grade bullish consensus everywhere, and this theme clearly could continue. But as portfolio managers, we can't just like a moth to a flame keep buying and chasing all the charts, even if retail are doing a lot of that, even if all the momentum algorithms and maybe even that the numbers support it. And we all own these things. The question is, are you going to get paid for your risk heading into earnings? And Taiwan Semi is a case in point. The first little travel and arrive, being long for earnings, is not getting you paid. But don't forget how many great opportunities there are in the rest of the market. We're so two-tier. Firstly, by the data center trade. Secondly, by consumer spending. Only the top 10% by income are doing any heavy lifting at all. For the vast majority, there is no real cyclical recovery. Wage growth not really making a difference, and most people are not buying more stuff. As a result, there's great dispersion in consumer discretionary names, great dispersion in software names, which I've covered quite recently. And this short Cintas is in my neutral cyclical book, industrials, materials, and any other cyclical stocks. So this cyclical recovery, broad-based, that we're all hoping for is nowhere to be seen yet and is a central catalyst effectively for Cintas. So let's get on to the stock. Trades at $188, $75 billion company, and it's market leader in uniforms. And of course, I'm talking work uniforms, not your weekend special uniforms. And this stock has about 35% of the market. 77% of their revenue is in their rental services business, and quite frankly, we'll just keep the focus here. They manufacture and rent out uniforms, and they service them, launder them, replace them, and they can design them with a company if that company needs them, and it's extremely good, solid business. Not sexy, but when you look at the chart, it's had a fabulous 2 or 3 years, as the economy has added a lot more jobs until recently. And of course, there's been a huge explosion in service jobs. Now, they also get involved in fire protection and inspection, bit of first aid, bit of shredding and new storage. They do clean room and hygiene for biotech and pharma. It's a big company, over 45,000 employees. It competes against Aramark. But Aramark, of course, does quite a lot of food services. It's not a direct comparison when you look at the stock and their quants, and Universe 12%. So when you have a look at the quants of Cintas, you'll see that revenue growth is 8% this year, falling to 7, 6 and 7 for the next couple of years. Earnings growth around 10. So a little bit of operational leverage and a very high valuation. The stock trades on forward PE of nearly 40 and a forward EV to sales of 7. Looks quite a lot like Costco in many ways. Market leader, well-run business, slow and steady, perceived to be very low risk. And when you look at the chart again, you'll see that it is off about 16-17% from its all-time high. Rightly so. There's a little derating on the way, and I think very much that this will continue. Now, when we actually think about uniforms, 23% of the US economy workers wear a uniform, and data from PayScale and the Bureau of Labor Statistics when they're at home show that 10 occupations most likely to require a uniform have median salaries less than $50,000. The median US income is 61. And of course, there are uniform occupations with higher income, police officers, pilots, firefighters, nurses, utility technicians. But broadly speaking, if you're wearing a uniform to work, you're more likely to be in a slightly lower paid income job. Now, coming out of COVID, a lot of services, a lot of jobs creation, and Cintas now has 5 million people wearing its uniform every day. That's up from 3.2 million in 2020, 56% growth in uniforms. Now, of course, this is the catalyst for the trade. Now, at an aggregate level, the US economy is quite comfortable in this no hire, no fire environment we're in, and I get it. And ICE has got a lot to do with it, because if you're not going to get immigration or you're going to cut down, the US economy can avoid recession if you're just looking at the desired unemployment rate of 4.1 or whatever. So I totally understand that the US economy now, because the structure's changing, doesn't need to create so many jobs. But if you're Cintas, you're going to struggle. Now, when you think back to the revenue numbers of sort of 6-7 going forward, 35% of their revenue growth every year comes from effectively job creation in their target markets. Hospitality, logistics, manufacturing, nursing are some of the main ones. And if, as I do, think that we're not going to get a cyclical recovery in service level jobs, and of course the medium term forecast I think will be even worse. When AI is going to really, if and when it's going to really cause job redundancies is anyone's guess. It doesn't appear to be in the imminent future, but I think this stock's got a long-term problem. Now, the last time the jobs market reflected no real jobs growth, and in fact a slowing jobs growth, was in 2019. People forget the economy wasn't in great shape going into COVID. And at that time, Cintas was trading on a forward PE of the high 20s and a price to sales of 4. So getting a price target's quite easy. I think those multiples over the next year or so will tend down. But in my time frame of January, I think 160 is a pretty nice price target, meaning I don't think that's asking too much. They report in mid-December, and you'll see a really nice return when we do the structuring. So just to recap, we've got a very expensive stock, which is well run. And of course, no one thinks we're going to get a recession, but if they don't keep getting new customers or growing the workforce, this stock looks super stretched. There's a nice pathway down to 160. And remember, this is all part of a neutral industrial portion of my book. I can't just keep looking at all the stocks that move 6 or 7% every day because it feels more fun. When you see the structuring of Cintas, finding low volatility names whose business models have got a big headwind or tailwind will make more money if you're right than chasing things that go up 10% a day. They've got to move so much for you to get paid properly. So when we come to the structure, we're going to do a January vertical put spread. So the January 180s selling the January 160s. You'll get another earnings print, and you've got a few months for the stagnant jobs market to continue. And remember, when you look at non-farm payrolls, they've only recently sort of collapsed from the 180s into the 20s and 30s. Another 3 months of this, and this stock's derating should just naturally happen. Not crash bang wallop, just the long holders gently selling. And if we buy the 180s for $5.70 and sell the 160s for $2.20, you can get 21 spreads for a $7,350 net spend. This assumes a fully invested $100,000 portfolio. And if the stock's at 160 by January, you'll make $34,650, a return of 471%. I think this can warrant a full position, but obviously as portfolio managers, it could be a half position that you'll increase if the macro deteriorates or you get closer to earnings. And however bullish you are on the data center trade, as a portfolio manager, you should have a couple of positions that are going to do very, very well if the unimaginable happens, if unemployment creeps up, or quite frankly, why I like this trade so much is even if the market rips higher, driven by data centers, it continues like it has. There is no reason to want to own this stock and no reason why it can't fall to 160. So there we have it, uniformly stretched. Thank you very much. I'll see you soon. Bye-bye.